Mode.
Good evening. My name is Chad Spearman with CattleFax. I'd like to welcome you all to the CattleFax Trends Plus Cow-Calf webinar. A couple of items before we get started. I did want to ask if you're looking at your screen, if everyone can hear me okay and can see our slide presentation okay. Would you please look over to your GoToMeeting box and click on the Raise My Hand so we can ensure that we have everybody seeing and hearing as we should. All right, thank you very much. I appreciate that. A couple other items before we move on. We will have the webinar archived on our website for 30 days after tonight's presentation at CattleFax.com. We're also going to have, in addition to myself, I'm going to lead off with the feed grains section here tonight, but also Lance Zimmerman and Mike Murphy from CattleFax. And if you would like to, throughout the webinar, you can type questions onto the screen, or you can also email them to us at webinar@cattlefax.com. And at the end of the webinar, we'll answer as many questions as we can get to. In tonight's presentation, we're going to take a look at the influence of new crop grain and forage production on 2014 cattle prices. We're also going to look at the fundamentals, supply and demand shaping the early 2014 cattle market prices. And we're going to look at some of the underlying trends for the spring and summer calf, stocker, and cull cow markets. There's a lot of moving parts with record prices being reached just in here this week. We're also going to walk through the economics of herd expansion and considerations regarding the bred female market as well. But first off, I'm going to work through the grain and forage situation, mainly the corn and hay situation here for 2014. We're going to start off with taking a look at U.S. corn production for the current marketing year, which is 2013 and 14. So we're looking at U.S. corn production for 2013 at a record large total near 14 billion bushels, substantial increase compared to a year ago as a result of a final yield that's going to be pretty close to 159 bushels to the acre, which is right on long-term trendline yields, but a significant increase in production and supplies overall. With that production increase, we're also expecting to see a significant increase in total corn usage. This is the sum of both domestic and export usage for U.S. corn, expected to be up on top of 13 billion bushels, with solid increases across the board when we look at each of the individual usage items on the U.S. corn balance sheet. We're looking for feed and residual usage on a year-over-year basis is currently expected to increase about 22%. Corn used for ethanol to increase approximately 8%, and exports are expected to nearly double compared to a year ago when record high corn prices and limited supplies left U.S. corn exports being rationed and offsetting that with global corn exports. We just didn't have the corn to reach the global markets like we've had historically. But overall, total corn usage expected to increase sharply as well. And the bottom line, in terms of looking at fundamentals relative to price, we use stocks to use when we look at fundamentals relative to price. And stocks to use is essentially measuring projected ending stocks, or the carryout for the corn marketing year, divided by the total usage for that marketing year. And what you can see in here in terms of the previous 3 market years, we had stocks to use levels well below 10%, essentially ending between 7 and 8%, which were historically tight, not as tight as the record low back in 1995 and 1996 of 5%, but historically tight for essentially 3 straight years, which supported and drove prices to record high levels. But now we're sitting in here with stocks to use levels currently projected at 12.4%. In terms of expectations as we go into the spring, stocks to use levels are expected to range from 12.5% to 14.5%, essentially into the April time frame. And you can see from a macro perspective that when the trend for stocks to use levels is working higher, you have corn prices working lower, and you can see the response in terms of the USDA's projected average farm price expected in there around $4.40 a bushel, a significant decline compared to last year and 2 years ago as well. So we've had a sharp decline in spot corn futures prices. This is looking at it on a weekly basis, down from the highs up on top of $8 back in 2012. The long-term trend remains lower, but the market has begun to consolidate in here around the $4.25 per bushel range. Now, if you look in terms of fundamental expectations for stocks to use between 12.5% and 14.5% between now and this spring, we would expect spot corn prices to continue finding support around the $4.15 to $4.25 per bushel range, but find stiff resistance up around the $4.50 to $4.75 range into that spring time frame. So the bottom line there is we have corn prices down substantially relative to a year ago and 2 years ago, and as a result of that we have significantly cheaper cost of gains, which is supportive for the livestock industry in general, whether we're looking at beef, pork, or poultry. One thing I would keep in mind in terms of the long-term trend here is, should we have Mother Nature here cooperating through this upcoming spring and summer, the odds are that we're probably going to build additional carryover to the U.S. corn balance sheet, which if we realize would also press spot corn prices even lower beyond this spring, down to levels as low as essentially $3.60 a bushel to around $4 a bushel into the summer and the fall of 2014. Another area where we're seeing significant decline in prices is dry distillers grains. This is taking a look at dry distillers grains on a spot basis the Iowa ethanol plant report from the USDA. We've seen a significant decline here just to start off this year from where we were on top of $210 a ton back down closer to $150 or $160 a ton. So a significant decline there. Part of that has been driven by the significant increase we've had with new crop corn supplies. We've had a substantial increase in U.S. ethanol production and therefore distillers grains production. And we've also gone through a time frame here in the fall where we've had record large distillers grains exports and a market there that has backed off. And the combination of all that has driven dry distillers grains prices lower. Wet distillers grains prices are also significantly lower. And both of them are starting to buy their way back into cattle rations as well. Next, we're taking a look at U.S. hay production and price. So we're looking at U.S. hay production in 2013. We saw a solid increase to more than 135 million tons for 2013 after the significant decline into 2012. So had a good rebound there in terms of production. And at the same time, for the market year is based on a May through April time frame. So the price we're measuring in here right near $180 for 2013 and 14 market year started in May of 2013 and runs to April 2014. So starting to have seen a decline in hay prices, but have the longer term trend is expected to continue lower into the fall, which will be supportive should we have more expansion going on and on down to the cow-calf sector. With the increase in production, we've also seen reduced disappearance during the time frame from December 1, 2012 to December 1, 2013. So as a result of that, we have on-farm hay stocks that have jumped significantly from where they were in 2012, still below 2011 levels, and still below the long-term average as of December 1. And lastly, as we take a look at hay prices one more time, but on a seasonal basis, looking at that market year that started back in May of 2013. Seasonally, you see your all hay price decline into the fall and the winter months, and then you see a rally back into the spring time frame as that demand peaks, which is typically going to be based on what the weather patterns are. But from a seasonal perspective, should see hay prices begin to find some support here into the spring time frame. But ultimately, if we have another good production year, should see even more relief in terms of costs, feed costs for cow-calf producers into the fall if we do have another good growing season. With that, I'm going to turn it over to Lance Zimmerman, who's going to walk us through the inventory, supply, and demand slides.
Thank you, Chad. As Chad mentioned in his hay and grain outlook, you obviously got a perspective there on our moisture situation and how dramatically that has improved over the last year. You've probably come accustomed to seeing the typical drought monitor slides, pictures of the United States and where critical drought areas have been throughout the U.S. This slide is a slight twist on that, in that it's looking at areas of the country that have seen the most improvement in their drought condition over the last year. Those areas that are dark green all the way down to light green shaded areas are areas that have seen an overall improvement over the last 52 weeks in their moisture situation, while those areas that are white and gray unchanged, and those areas that move from kind of a tan down to a dark brown are those areas that have actually worsened over the course of the last year. And as you can see here, major cow-calf country throughout the central United States down into the southeast have seen pretty considerable improvement relative to their moisture situation, which is key when you consider just how many cows are represented in that area. Roughly about 2/3 of the U.S. cow herd has seen some pretty significant improvement in their moisture situation. Unfortunately, our friends that are on the call today, the webinar today, in the West are still fighting some pretty tough drought conditions. Overall dryness in some major agricultural regions out there are going to limit a lot of the opportunities for expansion. However, we do feel that in a lot of the other areas of the country where large cow-calf operations reside, there's going to be an opportunity this year from a Mother Nature standpoint that really hasn't presented itself for the better part of the decade. Hearing numbers of guys call into the office talking about prospects of retaining heifers, retaining cows, not culling nearly as aggressively as they have in the past. And that's certainly welcome news for the beef production segment of the industry. The other thing that's changed considerably over the last 5 years is the economic situation regarding beef production and potential expansion. This year looks at the dollar per head change relative to a year ago at this time for these 6 basic commodity groups. The first 4 bars represent cattle prices on a per head basis. And you can see here whether you're a cow-calf producer selling at weaning all the way to a feedlot selling fed cattle, you're getting about an extra $150 to $160 per head compared to the prices you were getting a year ago. The prices for those utility grade commercial cows are commanding about an extra $90 to $100 a head right now. All positives when you look at the revenue side of our ledger sheets across the industry. From a cost perspective, the cost of finishing a fed animal is down about $200 when you look at the price of corn it would take to feed that animal to finish. Hay prices have also broken, as Chad discussed, but not near to the degree, obviously, that they have in the corn market. And so you look at a situation where big picture fundamentals suggest that looking into this next year, cattle producers finally have an opportunity both environmentally and economically to finally build on some extra breeding females and grow their operations, which we feel is going to start happening as we turn to 2014 into 2015. Now, this information here is the U.S. beef cow inventory. You can see very clearly the typical cattle cycle that we like to talk about here at CattleFax, the typical peaks where we build up herd numbers when economics and prices are favorable, the reductions in the cow herd as economics or even drought situations dictate reducing cow herd size. And we've been in a long-term contractual phase really since the late 70s. You look at this situation where we should have been expanding here in the earlier part of this decade, responding to the appropriate cattle cycle, the higher cattle prices that were ahead of us. We just never really did. We never got the chance with the drought situations facing us all the way from Texas all the way through the North Central Plains region. But what you can see is, as we work towards 2015, and this is a January 1st inventory number, so the 2014 numbers will actually just be published starting on next Friday's cattle inventory report. We anticipate seeing the herd transition from more of a stabilization period into a slight expansionary phase into 2015. I want to call your attention, though, to one thing in particular, and what you'll see here is in 2012, we were right at about 30 million head. It basically took us 2 years to get that cow herd down to 29 million. So 2 years to lose 1 million cows in the cow herd. In all likelihood, we expect this expansion to be a very slow growth. Producers are going to be very methodical in choosing how they expand their herd, and the cost investment for a female, at least on the surface, seems fairly daunting, especially when you consider the age of the typical producer. He's not going to be one that's going to be willing to take on a lot of excess risk in building back his herd. I think talking to a lot of producers, they want to let Mother Nature prove herself a little bit, and they also want to be sensitive to the fact that they're getting paid record high prices for their calves, and so being cautious and not expanding too soon. But nonetheless, we do see expansion is going to be well underway in the U.S. cow herd should Mother Nature continue to cooperate across much of the U.S., but it might take us as much as 3 to 5 years to get these numbers back to that 30 million target. Ultimately, a very slow, very patient growth rate as we look forward. One of the things that's contributed a lot to the decline is obviously the cull rate. We do expect the inventory report that comes out next Friday to have a culling rate that's significantly lower than year-ago levels, probably right there around that 10.8% range. And you can see in those trough years, those also correspond with years where we had cow herd growth, the early 1980s, the early 1990s, to a certain degree the early 2000s. We really need to get that number from a culling rate perspective down below 9% of the total inventory. When we break that number down into that range, we get to a point where you can truly see and experience a very sound cow herd expansion. In addition to that, you'll likely see the price for utility cows to continue to narrow the gap relative to the U.S. fed cattle price. But overall, really expect to see us get down below that 9% level about 2015. One of the other indicators that's important to us as we're looking at expansion is the idea of how many heifers are we truly sending to the sale barn. This is weekly USDA data, and it truly is one of the earliest indicators we have at understanding if expansion truly is happening. And so you can see here the 10-year average line really hovers around 40% of total feeder cattle and calf sales in the U.S. being heifers. Last year, if you look at that particular number in the orange line, particularly focused in around the red circle, from August of last year all the way through the end of the year, we averaged about 37% of all sales receipts being for heifers, and that was down 3 percentage points relative to a year ago. As we've worked into 2014, and really we only have 3 weeks of data, fresh coming off of the holiday season, you can see here we've had that reduction of about another 2 percentage points as we've worked into 2014 relative to a year ago. Very similar last year to our 10-year average. We're going to continue to watch this number very closely as we work through the spring sale run to get a good feel on exactly how many heifers do we have going into sale barns, how many are being pulled back and retained by cow-calf producers or other folks that want to develop those animals. Overall, this is our first chance to look at this data. We'll get additional confirmation as we get CattleFax member feedyard data, and we're able to evaluate what percentage of feedlot placements are heifers, and then we'll get another confirmation of this data as we start to get the cattle on feed numbers, as well as the slaughter numbers and how many heifers are available as a percent of the total slaughter mix on the fed side. And so really this is in its infant stages. As we work through 2014 and into 2015, we'll continue to be able to evaluate these numbers and gain confidence in how strong the expansion mentality is in the U.S. cow herd. If you think about it, if we have less cows going to slaughter, if we have less females going into food production, it's ultimately going to have an effect on our weekly commercial beef production numbers. And you can see here this is a weekly average by month so that we take out the effects of moving holidays, odd number of days, the way business days versus weekdays fall in a particular week. And basically this is the culmination of the reduced slaughter numbers that we expect to see both from a non-fed cow and bull slaughter standpoint as well as a steer and heifer slaughter reduction. As you look at those slaughter numbers in particular, for 2014 we expect non-fed slaughter to likely be down around 9%. That'd be the difference of slaughtering 116,000 cows and bulls a week compared to 128,000 likely this last year. Fed slaughter declines will likely be a much smaller percentage of the overall decline, down about 3% on average. And that basically account for a weekly slaughter rate somewhere around 455,000 steers and heifers a week compared to somewhere around 470,000 head a week over the course of 2013. When you roll this all up and think about it from a year perspective, commercial beef production will likely be down about 3.2% overall. We will see a slight increase in carcass weights, which is largely a trend line type of an increase over the course of this next year, as you see a change in the slaughter mix favoring more fed animals. In addition to that, cheaper cost of gains will likely encourage feedlots on average to feed cattle to a higher weight point, resulting in higher carcass weights. And so when it all rolls up by the end of the year, you're probably looking at somewhere around 24.8 to 25 billion pounds of beef produced in this coming calendar year. And that would compare to about 25.7 billion pounds a year ago. So not quite a full billion pounds being removed from the production segment. Imports and exports obviously have a factor on what supplies are available domestically. We don't forecast or expect any major changes on the net trade balance in the U.S. We do expect us to continue to be a net exporter of beef, which has been the case for the last 3 years, and expect a slight increase in exports up 2%, while imports will likely be mostly steady. Challenges here that we see obviously at the beginning of this year is the box beef cutout has basically rallied on choice boxes about $40 a hundredweight since the new year. A lot of that increase has come from chuck and round values, which are key muscle meat exports for the United States. As we've realized this price increase, we've likely priced away a lot of beef from potential export partners. We'll see how that manifests itself later in a lot of the export data. Typically it takes us about 2 months to get that data officially from the government. But overall, still see a very positive export story with some modest growth here in 2014. What does that translate back to from a per capita standpoint? Overall, as we work into next year, we do expect total meat consumption in the U.S. to be up about 1 pound, 203 pounds per person. And this is based on a carcass weight equivalent. And so you can see here the U.S. beef industry will likely see a 2.4 pound per person decline, while pork supplies, they've been mostly steady and hovering around that 50 pounds a person range for most of the last 60 years. The broiler industry, they'll be slightly up after a few years of chopping around 80 pounds a person, up about 2.6 pounds. And the turkey industry continues on their fairly stable and steady rate, right there around 18 pounds a person. When you look at this data, it's always alarming, I think, to producers to see meat consumption, beef consumption in particular, being down. A lot of this has to do with the supply reductions that we've been in. The drought, reducing production, reducing the available amount of beef that's available. But at the same time, it's also important to remember that since we've come out of the BSE situation, we've also been rebuilding some very robust export markets to the point where a lot of these pounds, not all of the reduction, but a portion of that reduction actually ends up overseas instead of being consumed domestically, which also affects this number. And so both of those things obviously have an effect on what we're seeing here. But overall, we do expect consumer spending on beef to be about the same as last year. The average consumer spends around $280 per person on beef. That number increased quite a bit all the way even through the recession, and has hovered right there around $270 to $280 a person for most of the last 2 or 3 years. And we don't expect that to change. So while pounds are down per person, the amount they're spending per pound is actually going up, which I think is a positive situation as we look at it from a beef industry perspective. One of the things that's been really interesting in trying to figure out where a price is going to be next year is we got to always look at supply and demand, obviously. It's really the determination of those two factors that gives us the market prices we all have to work with. Supplies are pretty easy to forecast from a relative standpoint. We can count inventory, make projections on production, and get at a fairly solid fairly solid production number. It's demand that's always a little bit more of a challenge, and this year's no different. When you look at the U.S. consumer, before we talk about this particular slide, consumer incomes are likely only up 1% at the end of 2013, and we expect them to be up more than that next year. But really, at 1% in 2013, they didn't even keep up with the rate of inflation for food products, which was up 2 to 3% from an inflation standpoint, and overall inflation was up 1 to 2% for the U.S. consumer. So from an income standpoint, you're always very concerned because in general, if all else remains the same, a 1% change in consumer income results in an equal 1% change in beef demand. But there's some other things behind the scenes that have been very positive. If you look at the stock market, the S&P 500 improved over 20% in 2013. So consumers are likely feeling pretty good about their retirement accounts and their other investments. Housing values have recovered and are again improving in most key real estate markets. And in addition to that, the consumer has done a far better job than our government has at getting their fiscal house in order. They've reduced their monthly debt payments considerably and got them well below pre-recession levels. And they've also been, since 2005, attempting to put more money into savings, which is admirable considering that most savings accounts aren't yielding very much money. And so I think that when you look at this Restaurant Performance Index, which is put out by the National Restaurant Association, what it tries to do is it interviews on a monthly basis restaurant owners and operators throughout the United States. And it asks them a series of questions based on their current situation in the restaurant business as well as their future expectations. And any values that are over that black 100 line suggest that there's expansion in that segment of the industry. Numbers below 100 obviously suggest contraction. What you can notice is when you focus on the tail end of that value, really, this is all 2013. We've been able not only to maintain this long-term growth trend, but we've also been able in 2013 to remain in what restaurants would consider an overall expansion phase. This is reflective of, I think, consumers really actually voting with their pocketbooks and saying they feel pretty good about their economic situation. Other indicators such as the Consumer Comfort Index, Consumer Confidence Index, Consumer Sentiment Index would all say the same thing. And I think you're seeing that manifest itself in overall positive growth in customer traffic and same-store sales throughout a lot of the restaurant segment. I think your casual dining segments, your Applebee's, Chili's, Outback-style restaurant concepts are still having to fight tooth and nail to remain competitive and relevant in the minds of the consumer. But when you hear reports from the fine dining segment, even quick service, those segments are really explosive. From a retail perspective, we've had to push record high prices back to the U.S. consumer from a beef perspective for at least the last 4 or 5 years. They've been able to manage and keep their retail featuring and advertised prices mostly steady for the better part of the last 24 months. But you can see here just how extreme some of these price increases are. The price of the average choice beef sale is up 5.6%, around $5.36. All fresh beef prices, regardless of quality grade, up about 6% as well. Ground beef's been one that's been really interesting. It's up 12.3% for the month of December relative to a year ago. There's been times that extra lean ground beef and lean ground beef in general has been up as much as 20% relative to a year ago. The retailers have been very conscientious at keeping their cut level prices fairly competitive with the rest of the wholesale price spectrum, but really used ground beef as their margin grab in the beef case. I think that represents both the value that consumers are willing to pay for that product and just reflects the overall convenience that the consumer places on ground beef. It's been a staple that's gotten the consumer out of the recession, and it continues to be a go-to item for consumers because of its versatility. You're looking at the pork segment, broiler segment, even turkey. Those price increases have been all across the board. Pork had a lot of ground to make up in 2013. Prices were exceptionally low in 2012. I think that's partially a reflection of what you're seeing with this December price. The poultry segment, actually, prices have been steady to slightly higher in most categories. The poultry segment, from an expansion standpoint, has actually probably been pulled back a little bit because prices have been weaker than I think they would have expected. Even though cheaper corn prices would allow them the opportunity for some expansion, the margin just simply isn't as robust as it would probably, as they would like it to be, because some of these prices aren't seeing the aggressive increases across some of the rest of the protein segment. Pork industry, production's likely going to be more steady as we look to next year, but we do expect demand to be higher. One thing that we're watching very closely is the porcine epidemic virus and how that affects the production segment there. It has yet to affect it right now, and expansion really seems to be ramping up in that segment of the industry. And if expansion becomes more concrete, we might not see prices up 5% like we did this last year in that segment of the industry. It might be more of a modest 3 or 4%. But overall, we're in a situation where tighter supplies are likely going to continue to drive higher protein prices for the beef segment next year, modest price increases for pork, and if that's the case, the chicken industry, the poultry industry in general, will likely get some additional support from those price increases as well. And so one of the things we always try to drill down to is, what does that all mean for overall beef demand? And demand's not an easy concept to measure because you can't just simply count it. It really encompasses those two questions in the upper right-hand portion of this chart. It's asking the consumer, how much product are you wanting to buy, and how much are you willing to pay for it? And so what we try to do is roll up the answers to those two questions into one index. It accounts not only for consumer per capita consumption, but it also accounts for that relationship between price and quantity. And we basically evaluate this on an index basis where 1998 is par, or 100, and every value to the right of that 1998 period represents either an increase or a percentage decrease from that base year. And so what you can see is, obviously, through the early 2000s, we benefited from a good economy in the Atkins diet. You can see how we broke away from that as the fat of that diet changed and we worked ourselves into a recession. And we've actually seen steady year-over-year improvement since 2010. This next year, as we look to 2014, this graph, we have demand down about 0.7%, and you can see in the text box below the bars there, demand slightly down in the other categories for wholesale beef demand as well as fed cattle demand. But overall, we feel that demand could be steady to plus or minus 1%, maybe even more robust than that, and up even higher than 1%, depending on what we know right now. Obviously, the robustness of the cattle market, the wholesale beef market right now, has us a little bit more optimistic than it probably did even before the holidays. But we're going to allow this market to prove itself a little bit here over the next few months and see how eager the retailer is to pass some of these record high prices we've been seeing over the last few weeks onto the consumer. if they're willing to pass them on to the consumer and the consumer is willing to maintain their beef purchases, then we could be looking at revisions to this number that are significantly higher as we go through the rest of this winter and obviously spring and summer. So with that, I'll pass things over to Mike Murphy now. He'll talk about how all these factors parlay into translating to the business decisions you all make every day.
Thanks, Lance. Well, as we look at how the market has had their travels the last 30 days, it's been a pretty amazing run as we think about things. We've taken the fed cattle market from the 130 level up to 147 to 150 was the range of where we trade fed cattle this particular week. And so it's a pretty significant change in how the market's been structured, and that's where we want to start our discussion. So as we think back to your guys' needs from a cow-calf perspective, a stocker operation, as you think about the process that you all go through day to day to be making decisions, well, we got to step and see what's your customer in terms of that cattle feeder. What's the decision that he's making? And on average, typically the cattle feeder is going to step out there and own a break-even that's somewhere at a level that's typically, more recently, at least in the last several years, a premium to those deferred live cattle. And so as we start to look at this particular graphic, what we're measuring here is looking at the daily live cattle basis minus the future strip. And the definitions, as you look in here, you can see live cattle strip is just the next 6 contracts average. So what we're doing is we're taking the February of 2014 all the way through December of this year, and we're just averaging that market as the strip. Then we take the most recent cash, and this has not been updated through today with the more advanced cash prices that we had today. But the bottom line is that the most recent cash we had somewhere in that 143, which would have been last week. And we just take that 143 cash minus the strip prices, and this gives you this daily live cattle basis. And what we want to highlight with this information is the structure of the market that's significantly different than where we would have been in the handful in the last 4 or 5 years. And you can see that pretty well when you look at years like 2009, 2011, 12, and 13. Those are those bold colors down in here in this area. And you see that the premium back in those years was significant, meaning the futures was a big premium to the cash market relative to the fed cattle. That was a bonus for you as stocker and cow-calf operators as you were trying to market those cattle. Now, clearly at certain times through that period, we had some challenges relative to the grain values, which was keeping a little bit of a limit on those feeder cattle and stocker values. But it was still a very supporting factor because we were always, as cattle feeders, betting on the come in terms of our purchasing decisions. Well, today we're in a completely different dynamic. We've got a fed cattle market, as I just referred to this week, that's somewhere in this 147 to 150 area. And we're sitting in here, when you look at the deferred live cattle from June of 2014 through April of 2015 in a range of roughly 131 to 136. And the cattle that you're going to look to sell not only here in the short term, but going out through the remainder of the year are placed against those deferred contracts that I just referred to. And so the structure, in a lot of ways, limits the feeder cattle market. And we're going to expand on that here in a few minutes as we start to look at a little bit more of this information relative to the data here. So keep this in mind that as we start looking at things, it's a different type of a structure. And if we're going to maintain this structure longer term here, as an example, into the spring, this will be somewhat of a limit to feeder cattle values. And potentially, if we have this type of a structure out there next fall, it could be a limit to calf values next fall on those calves coming off of the cow. And that's really what we're trying to address here when we start looking at some of these ratios in the market, these spreads, and the relationships between, in this example, March feeder cattle and August live cattle. So this is looking at the March feeder cattle of this year and the August live cattle. And the first thing that we want to point out relative to it is just the overall pattern in the last 6 months that they've tracked. They have a very similar shape to them. And the concept that we want to take home from this type of information is that if you're looking to sell feeder cattle, you want to pay very close attention to that deferred live cattle market that those cattle would be placed against. So a typical yearling animal coming out of the Central Plains during the month of March would be on feed for roughly 150 days and come out against that August time frame. And so monitoring what the August live cattle do is really important, because if they're trending down, then how does that influence feeder cattle? If they're trending up, how does that influence feeder cattle? And you can really start to see that the correlation in here is very strong between these two. Well, we can take that actually a step further in terms of this information as you look at the data here. And now you start to look at the March feeder cattle compared to the August live cattle. And it's just the spread. And that spread is measured here on this right axis. And what we want to point out is that the correlation between these two is very, very strong. Now, if we went back into this fall time frame, we were obviously talking about higher grain values. As we started to see corn market correct, especially as we got into the new crop version after harvest, then obviously the overall market went up, and that was led actually by the live cattle as well. But just look across in here over the course of the last several months, all of really the fourth quarter and into January here, and the spread between these two has been about $3 a hundredweight. $37 to $40 is that spread between the March feeder cattle and the August live cattle. And the point that we're trying to make is as we look out forward into the market with this type of a spread relationship, if we were to start to see where, for some reason, August live cattle were to get as high as, say, 135, then at the high end of this range, we could see March feeder cattle at 175. And so as you're thinking about your marketing plan going into this late winter, spring time frame, you really want to key in on those deferred live cattle contracts, which the March is going to go against the August, and the October will go against the October, the May will go against the October, to help you understand, is the feeder cattle market going up, sideways, or down? And then you can tie that back to what type of a marketing risk management plan you want to incorporate. Because clearly we have a lot of margin on these cattle, and we want to be able to take advantage of capturing that margin. But if the deferred live cattle are going up overall, then we don't have to be quite as aggressive with our risk management. And that's what this type of information really correlates back to. So when we think about the seasonality of the market, and my focus here initially is talking about this winter-spring time frame, if we have a deferred live cattle of August and October that's going to trade somewhere in here in this 130 to 135 area, then you can see as you look at this particular year for a 750-pound steer price, and this is CattleFax data, this is the range that they're going to trade in, somewhere in this kind of 170 to 175 area into the spring. Obviously, as we transition into the summer, we'll have a new dynamic relative to corn, and then we'll be starting to apply those cattle back to the August feeder market. Will be applied back against the December live cattle. But your focus in here between now and into the spring is that we're probably going to spend a lot of time in this low to mid-70s with the feeder cattle market. And if some reason we start to see the August or October live cattle lose ground from the current trading range, then there'll be a little bit of risk potentially to these feeder cattle. So this is that destined range in here based on the assumptions that laid out. We still believe as we move into the late summer time frame, as Chad would allude to, with cheaper grain prices, that will support this overall seasonality of the feeder cattle market of moving higher. But as you can look at this seasonal, it's pretty choppy through this whole winter-spring time frame, and we would expect the same to be the case this time around based on our assumptions of where we see the deferred live cattle trading. Now, as we look at the stocker market or the calf market, this is a different dynamic because we're going into an environment here where seasonally we have the green grass fever. And that's going to continue, even though as we look at our CattleFax U.S. average price, that's trading in here between 205 and almost up to 210 with this week's prices, there's still going to be some strength seasonally into this market. Obviously, Mother Nature will be a factor that we'll have to monitor with that. But at this point, the trend is your friend in terms of looking to sell those cattle. As we move into the late summer and into the fall, we'll typically have a correction to the market. And as we look at our webinar coming in here later this spring in the month of June, we'll address what that market looks like towards the fall time frame. But what I would tell you is that the overall concepts of these big picture macro trends are more in your favor, so it's not a situation where I think we have to get out there and be aggressively looking to try to contract our fall calves at this point in time. Now, as we shift gears, we start looking at the bred female market. This is just an index going back in here towards the mid-1990s, and if we think back to 96 was kind of the peak of the cow herd, and since then we've been in a declining scenario with our beef cow inventory. You can see how the index has moved. We've had rising bred cow prices all the way through here. In 2014, we would expect these bred females to move another 10 to 15% higher. Now, regionally, you may have some differences. If you're on that western part of the United States and you're in that significant drought, you may have some limitations there. Versus if you move back into more of the southern plains, or central plains and southeast where you've got better grazing and forage conditions. One of the questions that we've seen a lot from our membership in here recently is that when we think about the value of these bred cows, is there going to be any profit looking forward? Because we've seen a significant advancement to the value of these bred cows. And we're using this as just as a example, but I think it's pretty fair for a lot of parts of the country. If we're having to give $2,000 per head for a bred cow, what does that look like in terms of your return? And this is just kind of a down and dirty, very simplistic approach, but it's more to stimulate thought into saying that maybe these bred cows aren't necessarily overpriced. And all we're using as we go through here is we're saying on your calf crop, if you generate $1,000 per year on each of the calves that you sell for the next 5 years, that's about a $5,000 revenue. If your carrying cost for your cows is about $600, then over the next 5 years, it's $3,000. So your net for what you have to pay for that cow and what you're going to receive in terms of your net margin, they equal each other out. About $2,000 net, that's the cost of the bred cow. But when you look at the call value here in the year 6, as we look down the line, if it's somewhere right around $750, then there's a adequate type of return on this operation or on the entity of trying to buy bred females at these price levels. Because keep in mind, as you look at things during the last 25 years, the returns that the average cow-calf segment has generated have been always in that single-digit environment. And so these bred females are not necessarily overpriced is what the take-home message is. And if you're looking to step out there and restock because of some of the drought implications that you've had to go through in the last few years, we're certainly not afraid to step out there and do that. Now, as we shift gears in here and we start talking about the cull cow market, a lot of you, as you listen to our webinar or read our information back there in the fall, we suggested that you maintain and hold your cull cows as you wean calves in this fourth quarter time frame and carry them in here to this winter, early spring marketing window. And that's worked very, very well. Again, regionally, if you're in the western United States, the drought's been a very limiting factor for this. But otherwise, this has been a very solid marketing decision because we've seen these prices advance about $10 a hundredweight, and there's still going to be roughly another $5 coming to them over the course of the next 60 days. We would encourage you, though, to start to liquidate that inventory. Typically, that late January going into February is where you want to start to liquidate that cull cow inventory that you've maintained. And one of the biggest reasons is that the cows have gained about as much weight as they possibly are going to gain. But this has been a very solid environment as you look at it. So with that, as we start to think about some of the variables of the market and the take-home message today, obviously we're looking at cheaper feedstuffs in 2014. We're looking at a situation from a supply perspective that we're going to have a tighter overall supply, and we're looking at demand to be stable with the potential to have maybe a slight bit of growth. In general, as we look at the markets, prices are going to be very good at the fed cattle level. As we start looking at the feeder cattle and calves, it's more about that big picture basis structure of where we might limit those values of stocker cattle and feeder cattle. More so calves, I should say, towards the fall time frame. I would encourage you, as you look at some of this information, as you have more questions, we have some seminars coming up here through the summer time frame. Encourage you to reach out and sign up for those. You'll learn a lot more about all of the information that we shared with you as you start to look at these seminars here coming up in towards the summer time frame. So with that, we're going to open it up for some questions. And if you have any, I think some of you have been going ahead and putting a few of these out there. So as we start to look at things, one of the questions is that as we think about a replacement quality heifers, do we look to try to sell them as feeders here this spring, or do we go ahead and keep a bull on them and breed them towards next fall? And I would say, depending on your carrying cost, I would actually go ahead and carry those through the summer. Now, I'm looking at that more from a region of the country that you'd have the available forage to do that. But I think that there's going to be value to carry those through the summer, breed them, and sell them as bred females next fall. So that's what I would look to do if you're looking to do that. One of the questions says here is that all indications look like that we're in an expansion phase over the course of the next couple of years. What indicators would suggest to stop expanding? And I would tell you probably one of the biggest things is still Mother Nature. We all look at our partners in the western United States, and when you look at California as an example, it's the driest it's been in 100 years. And so if something was to change relative to the El Nino event and we didn't get some sort of a sustained pattern of moisture to come into the Central Plains southeast here through the late spring and summer, then I definitely think that would be something that would limit our ability to expansion. Outside of that, there's always that black swan event that none of us could forecast, but that certainly could be a factor as well.
We have just a little bit of time for some additional questions. One person did ask regarding membership. We did open this seminar up to both members and non-members to the industry. Somebody asked about how you can get a subscription or membership. CattleFax membership at the most basic level starts at $200 a month. And what that allows the cow-calf producer to do is $200 a year, sorry, $200 a year. That basically allows producers the opportunity to receive our monthly trends publication in addition to our weekly CattleFax update newsletter. The Trends publication is tailored specifically to cow-calf producers, while the update really covers the entire industry from pasture to plate. One issue each month is an 8-page edition that also encapsulates some analysis on the bred female cull cow markets. But every issue has commentary relative to the fed cattle, box beef markets, and even the feeder cattle market. Whether you're a stocker or a cow-calf producer, those stories are generally fairly applicable to you. In addition to that, we would have a daily email that would come about that would summarize the market activity for the day, a weekly video podcast that's sent out to members called The Closing Bell, as well as a weekly audio piece. Those memberships and those publications are all distributed via email so that you can get them immediately right into your inbox.
There's just a couple, we got a few more minutes for a couple more questions, and one of the questions is what we expect to see when calf prices would start to decline. And I think that as we look at it from a macro perspective, if we start to see expansion here in 2014, the first time we're going to start to see a few more available calves really hit the market, it's going to be the fall of 2015. But that's going to be a very limited amount. So the calves that you'll sell in 2014, 15, and even into 16 are going to be on the uptrend. Possibly in 2017, we could start to see that calf market level off a little bit at that point in time. And then the final question is that when do we expect to try to contract our calves? So a lot of people look to contract on the summer video, or do we look to try to wait till fall? And I would just tell you at this juncture, we're leaning to saying we're going to wait more towards the fall, but I think that's something to be really zeroed in on all of our information with our Trends publication, the CattleFax update, and then our next webinar, which will be on June 11th. We'll zero in on that question specifically and dial into what those deferred premiums really look like at that point in time. With that, though, I want to just say thank you for attending the seminar. We appreciate you being on. We've taken an hour of your time, and we hope that you found some value. You've seen with the seminars, you'll have a chance if you want to review it. It'll be on the web by noon tomorrow, Mountain Time. But on behalf of Chad Lance and myself, we appreciate your time, and thank you, and everybody have a great evening.